Investing is a powerful tool for building wealth and achieving your financial goals, but it's not something that you should just jump right into. Successful investing requires careful planning, research, and an understanding of the different factors that can impact your investment outcomes. Hey, I'm Britt, your favorite YouTube money coach, and in this video, I'm going to give you 7 questions to assess potential investments and figure out if an investment is a good choice for you. Now, if investing is a topic that interests you, check out our free investing masterclass. In it, we give you the secrets of successful investors so that you can create a life of financial freedom. The link to sign up is in the description below. Here are the 7 questions to ask yourself as you are making investment decisions. Number 1, does this align with my goals? Before you start investing, it is crucial to define your goals. Why are you investing? To build wealth and be able to retire? To grow your savings until your kid goes to college? To take advantage of a booming real estate market? Understanding your objectives will help you determine the appropriate investment strategy. It'll help you understand your time horizon, and it'll help you learn what your risk tolerance is. If you don't know what those words mean, don't worry, I'm going to explain them. Clear goals are going to help you provide a roadmap for your investment decisions and keep you focused on the long term. So before you do anything, I want you to write down your goals for investing. Why are you doing this? Number 2, does this fit my risk tolerance? So every investment involves some level of risk, but some investments like stocks have higher risk than other investments like bonds. Risk and returns go hand in hand. So the higher the risk, the higher the return. So finding the right balance between risk and return is crucial. Now, riskier assets tend to also have more ups and downs, also known as volatility, while less risky assets are more stable or less volatile. And depending on how much volatility you are comfortable with and other factors like your age or your financial obligations or your personal circumstances, those are factors that will go into making this decision of how much volatility you can withstand. For example, if you have a stable income, minimal debt, and a robust emergency fund, you may be more willing to tolerate higher investment risks. On the other hand, if you have significant financial responsibilities, a more uncertain income stream, you may opt for a more conservative approach. Generally speaking, the longer your time horizon, the more risk you might be willing to take on. Again, because you have more time to let the market go up or down before you need to take the money out. So you might be up for more risk in exchange for more reward. Now, if you're closer to retirement or you need to use the money sooner, like in the next 10 years, you'll likely want to build an investment portfolio that's slightly more conservative so it doesn't have as many ups and downs. Adding a variety of different investments into your portfolio can help lower your risk, but I'll get to that in a minute. All right, question number 3, does this match my diversification strategy? Don't put all your eggs in one basket is a common investment adage for a good reason. Diversification is a fundamental principle of investment risk management. By spreading your investments across different asset classes, industries, geographies, you reduce the risk of loss from any one type of investment. Diversification is a way of providing a cushion against market volatility, and it helps balance the overall performance of your portfolio. So I want you to think about how this investment fits within your overall portfolio and its potential contribution to diversification. So for example, if you were only invested in real estate and you were considering adding another property to your portfolio, this wouldn't necessarily be adding much in terms of diversification. So instead, if you're very invested in real estate, you might want to add some stocks to your portfolio, for example. As you're considering a new investment, evaluate how it aligns with both your risk tolerance and your diversification goals. All right, question number 4, does this align with my time horizon? Your time horizon is the length of time that you're willing to leave your money invested before taking it out. Short-term goals, such as buying a car in the next year, might require more low-risk investment, like a 1-year treasury bill. Long-term goals, like retirement planning, can allow higher risk investments with the potential for greater returns, like a stock portfolio. So you want to align your investment strategy with your time horizon to maximize the growth potential of your money. All right, question number 5, how much does it cost and what are the fees? Investment costs and fees can significantly impact your overall returns. So beyond the upfront cost of making an investment, there are likely other expenses. And before making that investment, you want to understand what expenses are associated with it, including management fees, transaction costs, and taxes. You want to look for low-cost investment options like index funds and ETFs. They provide broad market exposure at a much lower expense ratio. Unless you're building a values-aligned portfolio and have specific desires to pay higher fees, you can generally look to avoid paying any fees above 0.3% when you're investing in the public markets. For example, Fidelity's has a 500 index fund with a 0.02% expense ratio. Vanguard has a total stock market index fund with a 0.04%, and then target date funds at Vanguard have an expense ratio of 0.15%. So all of those are below 0.3 and are all going to be low fee. Generally, the difference between 0.15 and 0.45 isn't going to make a huge difference. But when you pay a financial advisor 1% management fees on all of your assets, in addition to the expense ratios involved in the individual funds, it can add up. If anyone is trying to charge you 1% or more to manage your money, the general rule that I say is run in the opposite direction, unless you have reason to believe you're going to get exceptional returns or strong values alignment. But more on that in another video. Number 6. What is the liquidity? It's essentially the ability to get your money out. If something is highly liquid, you can get your money out easily and quickly. And if it's less liquid, it means it's stuck for longer or there are limitations on when you can get your money out. So your ability to exit the investment or get your money out is a factor when you're considering what to invest in, because it depends on how long you have to leave your money invested. So if you're investing for a long time horizon, then the liquidity matters much less. If you're investing for 5 years, you want to make sure that you can get your money out within 5 years without having much of an impact. Now, just because you can technically liquidate an investment, meaning you can get out of a stock pretty easily if you invest it, doesn't mean you should. Ideally that you're letting your investments grow over time, and so you're keeping them invested. Generally, when you're investing in the stock market, you want to make sure that you're planning to invest for at least 5 years. If you're investing for less than 5 years, you might consider things that are much more secure, like T-bills or certificates of deposits, also known as CDs. These are things that have some liquidation rules, like you can't take them out before a certain amount of time, but the value isn't going to change much in those 5 years. All right, question number 7, what is the market doing? Now, I don't recommend trying to time the stock market, and if you want to know why, I explain it in our investing mistakes video, but I'll link to that in the description. For now, I'll just say it's a stressful and ineffective way to invest. But that's not to say that you shouldn't pay attention to what's happening in the market. So, for example, in early 2022, the US was in the middle of record-breakingly high inflation. Because of that, stocks were down, but more importantly, other investments were up. I-bonds offered an almost 10% return, and the interest rates on high-yield savings accounts were rising. When the stock market is down, don't panic. It's actually a great time to invest at a lower price. But I also want you to stay aware of other lucrative investing opportunities as well. So that's why I want you to pay attention to the market. All right, investing can be hugely rewarding, but it does require thoughtful consideration and informed decision-making. So by following these tips and asking these questions, you can increase the likelihood of your long-term financial success. Remember, patience and discipline are key when it comes to investing, and seeking advice when needed can provide valuable guidance along the way. Like I mentioned, if you want to up-level your financial knowledge, check out our free masterclass. They'll help you set yourself up for financial success so that you can enjoy peace of mind and pursue the things that really excite you. The link to sign up is in the description. As always, thank you for watching, and I'll see you in the next video.